Bingo.
There we go. All right. Thanks, everybody, for coming. We're going to go ahead and kick it off now. Today, we have the Miami University Blockchain Club is presenting Blockchain and Accounting with speakers Kyle Kaufman from EY and Professor Ballou from Miami University. Like I said, thank you, everyone, for coming. And Kyle is going to go ahead and kick it off.
Hi, everyone. Thank you very much for having me here today. Special thanks to your great professor and Alex. We have a nice, intimate session today, so do not be bashful with questions. Biggest goal of the day, if you haven't had your blockchain light bulb click on yet, we want it to. We're not going to get too technical. We're going to make it very relatable. And we want everybody to walk away and be able to go back to their friends, family, your next virtual happy hour, you name it, and explain blockchain very eloquently. So that's the goal for the day. As I introduce myself, I am an assurance senior manager in the Columbus, Ohio, Ernst & Young office. I've been with EY for 11 years. I have served about 10 different clients, but spent the majority of my time on a large pharmaceutical distributor. I have time with consumer products, retail, not-for-profits, automotive part manufacturing, and even some insurance clients. So I've seen a lot of audit work, and that's really where my passion for blockchain began. When I truly started to understand what blockchain is, and I realized the ramifications it could have on both accounting and our audit practice, I knew I had to expand my mind and run with it and learn as much as I could. So as we move into the presentation, the first thing we'll start with to get everybody juiced up is some technology evolution. What I want to highlight here is the growth of technology over time. Alex and your professor have probably heard me talk about this before or seen it before, but technology is undefeated. When you look back 100 or 200 years, humans are a brilliant species. And if you look at the computer in 1990 versus a computer in an electric vehicle today, in 20 or 30 years, it is absolutely stunning to see what we've done. Similarly, when I was in school, I love showing this. I don't know if anybody knows Jack Gilchrist or Ashton Barger, who are Miami grads, but I asked them what this was the first time I met them, and they both told me it was a copy machine or a Xerox machine. They're both wrong. It's an overhead projector. When I was in school, probably up until about my junior year of high school, which was 2003 or 2004, this is how my teachers taught me. Literally would scribble with a vis-a-vis marker on a clear piece of paper that went on the screen and write down things like you would do with a PowerPoint today and then project it up onto a screen. That was how we were taught until computers became the norm and PowerPoint and the Microsoft suite took off. So again, short time period, massive changes. As a big Tiger Woods fan growing up, certainly remember watching a lot of Sundays with my dad. You can see in 2002, not one person in the crowd is watching him with a cell phone. They're truly watching him with their own eyes. When you fast forward to current day, you see nothing but people watching Tiger through their cell phones. So another great example of technology thriving and taking off. And what I really love about this graph here is, earlier I was talking about technology over the 100 or 200 years of the United States and across the world. This graph depicts that, whether it's the vacuum, the cell phone, the TV, the microwave, the washer, a landline, all of them go on these pseudo-parabolic adoption curves throughout history. And really the only time we saw a slowdown was when we had other events going on, like World War II, period here. But as we start to move into blockchain, and a lot of people say, hey, blockchain's just too confusing, it'll never work. Guess what? When you think back to a washing machine or a microwave, That was just as mind-blowing that many years ago as blockchain is today. But look where we are now. So I tell anybody, keep an open mind. Humans are brilliant. Technology has a phenomenal track record. All that said, let's move into what I think is a really good kind of overview and really kind of EY's mission statement on what blockchains will do. I'll read this off. Blockchains will do for networks of enterprises and business ecosystems what enterprise resource planning, ERP, did for the single company. And the way I want to frame this up for everybody is to kind of get a snapshot of the current day. So if we think about companies in the current day and us doing accounting or audit work for them, we're gonna pretend this supply chain relates to shoes. And in a shoe supply chain, you certainly have the manufacturers and the vendors here in this top square. You have distributors, and I think it'll be best if we take the scenarios, if we're distributors, let's call it Alex's shoe distribution company. And then we have customers, let's call those the Foot Lockers, the Finish Lines, where humans go to buy shoes. In the current day, each one of these entities, whether you're the manufacturer, the distributor, the customer, has a contract. That contract may say, hey, every time Alex's shoe distribution company purchases from a vendor, that vendor owes Alex some portion of a rebate that's contractually stipulated. Alex has the same thing with his customers. He may say, hey, every time Finish Line X buys 100 units of shoes, we're going to give them a rebate. And that's going to be signed in an agreement. And each one of these entities also has a computer and a suite of systems and ERPs and inventory tracking mechanisms that they use to account and record all of these transactions. One has its own. In theory, everyone should have the same answer when it comes to the rebate, right? We should know the number of shoes we bought. We should know the number of shoes we sold. We should get to the exact same rebate owed and rebate receivable. Being an auditor for 11 years, guess what? That does not happen. And on top of it, the processes to track this are tough. Lots of reports, lots of manipulation of the reports, lots of taking a report and inputting it into Excel and dragging in other data, all this manual compilation, controls set up to prevent any errors in the process, take a lot of time, and each entity has its own. So when we go back to EY's mission statement and talking about blockchain's doing for the network of enterprises what ERP did for the single company, that's the concept. The goal of blockchain, the promise of blockchain, is to make a single source of truth between these entities so that every time a shoe unit is sold, we can all agree it was that unit times that applicable rebate rate based on the agreement that one party owes another. And that's the beauty of it and kind of the mind-boggling thing to wrap your head around. I want everybody to just kind of reflect on that for a minute as blockchain being the single source of truth for this whole supply chain, rather than each entity having its own process. Blockchain can deliver on that. We will see a truly changed world. And going back to the technology concept, I've certainly heard my bosses at EY, kind of esteemed partners who've been with the firm for 30 years, my parents, they all talk about this time in their lives pre-computers or pre-internet. And we can't imagine that as millennials or Gen Zs. You almost can't imagine it. I have an inkling that blockchain is that version for us as the internet and computers were for us. So let's move into a little bit more blockchain specific discussion. I really like this slide here just to kind of build on the concepts we talked about. In the current state, there's a low level of system integration between supply chain members, even within a company. there are a lot of systems that a lot of times don't talk to one another, that make reporting very difficult. Create siloed information, disparity of information between users, and the manual processes. In a future mature state, scalable blockchain, we can connect all this, create a single source of truth and automation, which I think you hear a lot of people get a little bent out of shape when you hear about automation. You say, well, okay, what are the humans going to do? My response is, it will just change what the humans do. Humans will have to become slightly more technologically savvy, but the redundancy of the manual processes that I think humans are too smart for to begin with are what gets eliminated. So we'll spend more time upkeeping the blockchain, testing the IT controls around the blockchain. I don't get bent out of shape about humans all of a sudden going away and computers and technology taking over. It just changes what we do, and we've seen countless examples of that over time. So, a few blockchain considerations before we dive into some key definitions and key concepts. I think the first thing I like to tell everybody is blockchains aren't a solution for everything. Sometimes existing systems or existing processes are just fine, but other times blockchains are phenomenal and just what will be game-changing solutions. So at EY, there are 5 really key questions we like to ask clients to determine whether a blockchain is an appropriate solution. Questions are as follows. Are there multiple parties in the ecosystem? Is establishing trust between the parties an issue? Is it critical to have a permanent tamper-proof record of the transactions? Are we securing the ownership of a finite resource? And does the ecosystem benefit from improved transparency? So if 4 of those questions are yes, or 5, hey, even 3, kind of a check in the column of blockchain could be a really good solution. So what we're going to do now is talk through some technical kind of key concepts of what blockchain is. After we do this, I'm going to give you what I think is a really good 4-word definition of a blockchain. I'll challenge everybody to try to come up with a better 4 words. I love 4-word short explanations of things. Hopefully mine makes sense. If you're able to come up with a better one or you hear a better one, email me, reach out to Alex, have somebody talk with me. But let's start with some technical concepts. So what is blockchain technology? Distributed infrastructure technology that keeps record of transactions in a decentralized format. A lot of buzzwords. One really good way to think about that is a shared record. We're thinking about a single source of truth. It's a record book that we can all agree on and share, that this is the truth. These are the sales of units or the purchases of units that members in the supply chain make. So when you hear this distributed ledger technology, DLT for short term, just think of it as every participant in the network keeps a copy of all the transactions, and the transactions are secure. Distributed, that's all the participants. That's just kind of cut it down and define it as simple as you can. Okay, consensus algorithm. This concept here I think is really key and probably the one that really emphasizes the distributed term. So in the current day, when we go back to our slide here about that shows what each entity has to do to maintain their records, the systems they use are the central authority, right? They are the authority that records the transaction. In a blockchain, there's no one central authority. Every participant is the authority in the room. No one node, no one server is responsible for approving transactions, which leads to a truly distributed transaction process. All entries are validated and recorded on ledgers across the network. And how I think is a really good way to think about this is, in theory, if we call the consensus algorithm being that the blockchain is going to validate all transactions that meet certain criteria, let's say it's a sales invoice, matches a purchase order, matches a scanned inventory. As long as those three conditions occur, and the nodes, aka the computers upholding the network at a consensus majority level, agree that those three conditions occurred and match one another, the transaction's going to process. So the reason why this is so hard to beat, especially for Bitcoin or Ethereum, these very highly built out, lots of developers, lots of miners, lots of nodes, to trick the blockchain, in other words, you would need to overwhelm it in such a fashion that greater than 50% of the nodes would be fooled. And that takes an enormous amount of computing power that costs in the millions of dollars. And that's one of the concepts that makes blockchain so. You have to overwhelm the majority of the nodes. And that's the distributed concept. You have nodes on their own working together to validate transactions. And as long as the majority agree, the transaction. Key concept, I did see a question come in. See what we have here.
No, that was me. We're getting some feedback from your mic. I know.
How do I sound now?
Much better.
Better. I'll blame the desk and the metal built into the desk. So, okay, next up. Just call me out again if we have issues. Smart contracts. Another absolutely key feature for blockchains. I want everybody to think of a smart contract as literally programmable logic within a blockchain that could represent an agreement between two parties. So back to the example of Alex's shoe distribution. If we had a rebate between a customer and a vendor, Alex had a rebate with a customer and a vendor, we could program logic into a smart contract that says, hey, every time 100 units get sold, multiply it by this rebate rate and record it as long as our conditions. That is the feature that makes blockchain so valuable to hopefully one day companies. The fact that we can make business contracts live in a blockchain with a smart contract can do phenomenal things, especially when you realize that a distributor doesn't just have one vendor or one customer. They have hundreds of them. And each one of those contracts may have unique terms that need to be programmed into this. So I'll pause for 30 seconds. That's the most technical we're going to get right now. Any questions? All right, we're going to move on to the fourth. You thought we only had three, we're going to move on to the fourth. I'd say the last key definition to master here are tokens, tokenization. What are tokens? What is tokenization? All it is a digital representation of a real life asset on the blockchain. So I think this graphic does a really good job of explaining this and highlighting how a token would work in a supply chain. But if we go back to the shoe example, when our three conditions occur, an invoice matches a PO, matches an inventory, or a scan out. If we program that into the smart contract and all three conditions occur perfectly and the nodes agree and when the consensus algorithm says, yes, valid transaction, that token can effectively move from point A to point B, which might be Alex's distribution warehouse, to the truck that's transported. Okay? Guess what? once that truck arrives at the customer's warehouse, and there's a scan at the customer warehouse that matches the previous 3 conditions, that token may then move from the truck to the customer's. And this is how you hear about blockchains being phenomenal, track and trace, tracing inventory, which we'll get into a little bit later. This is how it would do it. The only way that token moves in the digital blockchain is when real life conditions occur. And that's really difficult to do in the current state of IT. So if we think about from an accounting standpoint, what can that do? My mind goes directly to, let's think about sales and transit calculations, inventory and transit calculations. Companies go through data intensive procedures and processes to estimate inventory that's en route to their warehouse, or maybe their shipping terms, their FOB destination. So they try to estimate how much sales that were recorded that they need to back off because they haven't arrived at the customer. Using estimation. Guess what? Using a blockchain where we know because of the tokens exactly where that inventory is, a lot of that estimation goes out the window, and you know your inventory in transit or sales in transit adjusting entry just through the blockchain. One example of the many things blockchain. So just visualizing this again very simply and kind of going through the key concepts of how a blockchain would process a transaction. Call it a simple life cycle, and we're gonna pretend this is no smart contract. We don't have kind of complex logic built in. It's just simply how would a Bitcoin move from wallet A to wallet B? So the first thing that happens is, let's call it wallet A wants to send tokens to wallet B from its address in the ledger. Transaction is broadcast to the nodes on the network. The nodes approve the transaction. Here's all I want everybody to think about when the nodes are doing this for a Bitcoin. Wallet A, a valid address. Does wallet A have Bitcoin in it? Is there a digital signature authorizing the movement of the Bitcoin to wallet B? Is wallet B valid? If all those things occur and the nodes agree, that Bitcoin's moving from A to B. Transaction is bundled into a block and added to the blockchain, which provides an immutable and transparent record. For public blockchains, all the transactions can be seen. Subsequent to all that occurring, Bitcoin is in address B's wallet, and everybody can see it on our shared record. Do a quick 15-second pause. I'll maybe weave in a inventory scenario like we talked about, but are there any questions? Stuff. So if we were to weave in a smart contract, it's really all the same principles. It's just that the nodes need to agree that the conditions in the smart contract occur. That's really the subtle difference. But again, it's really just reading code. We know machines are great at that. I think another good view of things, and just thinking through, okay, central authority, today's world, pre-blockchain, you have one entity that effectively in charge of everything occurring appropriately. And hey, we've seen plenty of data breaches, hacks over the years where it causes a lot of strife in a supply chain, or even just for a company when you lose the trust of your customers because privileged or customer specific data has been put out into the wild, so to speak. So relating that to a blockchain, you don't have a central authority. That concept has a lot of value for companies and individuals. So I'm going to introduce you to Kyle. Like I said, hey, Kyle's got a forward forward blockchain description that he likes. We did one really good one, shared record book earlier. So this is a Kyle thing here, not an EY thing. But again, encourage everybody to come up with their own if you have one. But I think a really good way to think about blockchains are secure shared trust machines. I think humans have a lot easier for us to relate to tangible items like a machine. So if we think about blockchains as churning out transactions and that they're secure due to the distributed nature and the consensus algorithm, yet they're shared because all participants have equal viewership, no one owns it. I think it's just a really good way to simply explain what a blockchain is. So we'll spend a quick minute here differentiating Bitcoin from Ethereum. Probably if you're in the media, if you're hearing anything in the media or you're on the internet researching, there are a ton of blockchain projects, crypto projects, decentralized finance projects out there. These are the two biggest in market cap and what a lot of people talk about. So Bitcoin, a lot of key terms you'll hear people describe it as are monetary network, digital gold, or store of value. The reason a lot of that comes in is because there are only 21 Bitcoins that'll ever be mined. In theory, that's a very scarce asset. And I think the digital gold narrative's caught on very heavily today with a lot of the money printing being done across the globe to kind of secure up our markets and provide some stability during Corona. But the way I like to think about it is, hey, gold has been a store of value for humans over thousands of years. But humans are really the ones who've given gold the value, right? We could go to another planet and gold could be abundant on another planet. That species of that planet may not value gold. It could be wood because it's scarce. Humans have given gold value for thousands of years. It's stood the test of time. And entering a digital age with a digital asset like Bitcoin that's scarce, kind of seen the shift in mindset. Hey, why can't Bitcoin be digital gold? Obviously, the prices follow that. So if you're hearing that in the news or the media, that's some of the concepts behind it. I think the one thing people sell short a little bit is the monetary network aspect, knowing that we can send Bitcoin thousands of miles away from each other with our cell phones, without a central authority. That monetary network aspect is powerful. Combining that with the scarcity aspect really creates kind of the rationale for why Bitcoin's doing what it's done from a price. Point I want to make on Ethereum. Ethereum has smart contracts. Again, we know smart contracts as programmable logic that may represent business rules of a contract between two parties. Bitcoin does not have smart contracts, Ethereum does. And you'll hear people say, hey, that's why Ethereum has this enterprise blockchain and utility concept associated with it. Ethereum for now does not have the same scarcity as Bitcoin. There are some interesting things going on with Ethereum development where we may see it get a little bit more scarce over time, but that's coming. But yeah, I think if you just think of Ethereum as the enterprise blockchain because of the smart contracts, that's a really easy way. So, all right, summing up the value of blockchains before moving on, what are 5 to 6 really good value concepts of it? First, increase transparency across the ecosystem. Eliminate some of this manual reconciliation that I talked about earlier. Automate contract execution, audits, and reporting. Leveraging of a single immutable version of the truth. Increasing data accuracy and real-time analytics. And lastly, integrating silos. Those are 6 really key aspects that almost go hand in hand with the 5 questions that we brought up earlier that we like to ask potential clients. So with that, why don't I hand it off to your great professor here And I will be back for part 3. I'm going to queue up the other PowerPoint really quickly. And they're off.
So while Kyle's doing that, my name is Brian Ballou. For those of you who haven't met me, I'm the EY Professor of Accountancy in the department, and I've been here since 2003. I teach a lot in the auditing area, and I have a background in enterprise risk management, sustainability, corporate governance, issues like that, a lot of 21st century type stuff. And the reason you see the KPMG on here is because that firm has worked with our department to fund a series of curriculum development modules for the next 5 years. And the past summer, I started one in blockchain that I'm teaching right now in the Master's of Accountancy graduate assurance course. In fact, I'm doing it this week. So this has been helpful. I'm coming at this from what does this mean to me? In other words, Kyle's an expert. I'm literate. And the idea is that that's what everyone needs to become, is literate, so they can learn to work within whatever context you're going to be working for in your careers in accounting or finance. At a minimum, you want to become literate. And then as it gets more involved and you get more comfortable or you're more interested, then you move further down that path and you're more like Alex, where you've decided this is something I want to pursue for my career. So Kyle, you can go ahead and I'll just say next. And what I'm going to do is kind of tie together a few things he said and cue up what he's about to say in a few minutes. I'm most of the time tonight, for Kyle, it's always better to hear from professionals, but some practical aspects as you think about what you're doing in the classroom and what you think about going forward is that smart contract is the game changer within transactions and business processes. Not necessarily if you're out there using a substitute, type of currency like a Bitcoin instead of cash or something else, but the ability to actually speed up and change the way exchanges occur, because once the conditions met, it's instantaneous. I'll get back to that in a minute. He's already mentioned everybody's got the same version of the truth, but there's accounting implications for that, as well as with the reconciliations no longer being necessary. There's some career implications for that if you're going into accounting. One thing that I don't think came up that's really important, you heard Kyle mention that a central authority has all this data. Well, in traditional accounting, anytime you buy from somebody, you pull information from them. So in order to trust them, you need all this personal information, addresses, phone numbers, your credit history, last 4 digits of your social, credit card numbers, all that. In blockchain, you push a transaction, you push money to other people with 2 long codes, crypto codes that are called keys. And it's up to you as to what you convey, but you don't have to convey anything to the other party except your key. And at the end of the day, you can make a transaction pretty much without knowing that much about the other party, because the blockchain is where the trust comes from, which from a corporate standpoint reduces a lot of risk for capturing data. And with some new regulations in Europe and the United States, that takes a lot of liability off the books of a company when they don't have to capture as much data as they used to about their customers or their suppliers. So that's a real important issue as you go forward. And then just as he said, it's hard for fraud. So we can go next. What I'm going to talk here is how it's going to affect first the accounting profession, and then how it affects some of the companies and clients out there, depending on what you're interested in doing. Clearly, Kyle's been talking to you like a consultant, right? Hey, as you answer those 5 questions that he had up there earlier, do I need blockchain? And if so, how would I do it? How would I design it? How would I integrate it with the systems I already have? How do I have them work alongside each other? When would I use crypto assets? When do I tokenize assets? You're going to see Big 4 and other consulting type firms that have accounting backgrounds. They're leaders in this area. Next, if you're thinking about tax, game changer, right? Compliance and tax collections. Who needs a tax return, right? Smart contract will end up being your tax return. If you owe payroll taxes, sales taxes, build it into the transaction. So when you buy something, okay, right then, the local state authorities are paid. It's tied into the transaction. It's reconciled. It's one version of the truth. There's no need for a tax audit. There's no need for any tax return. Assurance, my background. In this case, and it's something EY is developing now, they can put in what's called an analyzer that pretty much, goes the entire length of that transaction chain he was showing you earlier, and can say it's valid. That's the work paper. So I don't even need to document anything else. It's pretty much that process itself on a continuous basis can let me know that transactions are valid. So tax and auditing, where a lot of you would go as accounting majors, fundamentally would be transformed. Next. Let's talk a little bit about some careers. Finance. I'm not going to say a lot here because Kyle's going to come back to really that, for lack of a better word, the first and fourth bullet, which basically means I don't need banks anymore necessarily, or banks can serve as an intermediary if it's a private blockchain and do a few of the functions they did before, or they can let people who have Bitcoin are afraid they might lose their key. They'll let somebody else hold it for them, and like a custodian. Like if you gave a bank your money, well, you might give a fintech company or a bank your cryptocurrency because of all the controls that you need to have. That can happen. Right now, when I want a new company, I might have an IPO, raise money. Well, what if I just need new currency to fund a project? I can do what's called an initial coin offering and come up with a new crypto asset. So there's lots of ways to kind of think about it. The third bullet basically says we don't really need cash anymore. I've been telling this story for a long time. Last March, I had put 50 and a 10 in my wallet. Drove down to Auburn to film a virtual internship, had to use a $10 bill once. The $50 bill is still in my wallet. You don't need cash anymore. So electronic currency, perfect for blockchain. Next. Supply chains. He's given you an example already. The key here is blockchains are technology, but you can build platforms on top of it. So users look at effectively a dashboard in a way humans can understand, which is very much like a dashboard. And so all the authorities in the supply chain can look at the same dashboard, and the manufacturer can know the goods have been shipped, right? The customer knows they're on their way. Customs know exactly who's seen what, and it's done in a very much instant way. And when people are owed money, when it hits certain stages, that can be done with a smart contract. People can be paid right away. Next. The share economy. Facebook's been in a lot of trouble for getting in the way and being a central decision maker. A group of people can get together, create their own blockchain, their own social network. We don't need Facebook. Neighborhoods can get together, decide that they're going to create a blockchain for sharing their homes when they're not there. We don't need Airbnb. So there's a bit of a threat with blockchains with some of these intermediaries, these platform companies that you've had to use. That would include Uber, ride sharing, and other things as well. So really a lot of interesting possibilities. Next one. Marketing. Think of all the ways marketing, all the efforts taken to get your data. Think of Facebook and all the data they've had to capture then to provide to marketers. Well, if you can tokenize, if you have a token and you can reward your customers for responding to your ads or your surveys, hey, take the survey, we'll send you tokens for our products right now. Now you're paying customers for their data. That's a big ethic issue. And now you're rewarding them. And that's what these micro payments are. It enables you to develop better, more trusted relationships with your customers. Also, if there's copyrights or there's royalties, which we'll get to a little bit here, but I'm going to save most of that for Kyle. Again, you could build a smart contract and make sure the IP holder gets rewarded along the way. So really a game changer for customer relationships. Next one, artists. So if you saw the Grammys last night, well, okay, Taylor Swift wins Album of the Year. She's big into this sort of thing. She's like, okay, I'm sure a lot of people are streaming my album today or different songs from it. One, how do I know those? I'm getting good information on what's being streamed because I'm owed something for each one of those. Oh, and by the way, when am I ever going to get paid? Well, if I've got a smart contract tied into that, with Spotify and Apple Music, every time it's streamed, it's captured, I'm paid instantly. So again, it's slow on the front end right now when it comes to processing transactions, but that lag of when you finally pay and do the royalties and all those kinds of things that Kyle was mentioning earlier, a smart contract can make that instantaneous, and that's a game changer for a really difficult area for accounting. And I'm just going to walk through this example. This was in Harvard Business Review last year. This is why accounting and finance is such a good background. If you're an IT, a systems person, and you start hearing about blocks being built, that may be new to you. You're used to master data and it being changed and data being transformed. But accounting has always been about building a general ledger and tracking transactions over time. What the blockchain does is it enables you to mix in with the financial transactions that are going along, the movement of the actual goods and services, and information flows back and forth. So that dashboard has all of it. So if you look at this left and right, if a retailer puts an order with a supplier, says I want shoes, going back to Kyle's example, traditionally there would be nothing there. It's just information. But the blockchain will record both that order and that acknowledgement of order. So there's already 2 levels of block. Next. Yeah, and so then the supplier needs money, okay, to build and manufacture the shoes. Goes to a bank, applies for a loan, bank sends money. All right, so now we've got information and we got cash. So the retailer wouldn't know anything about that normally, but it's the same chain being built. So now the retailer knows, yeah, they're going to make my stuff. They got financing for it, so I'm waiting for it to come. Next, okay, I'm sorry, go back one. Next step. Next, the supplier invoices and ships the merchandise to the retailer. So they make it, and they also send a bill. Bank sees that too. That's 2 more blocks. All right. The retailer pays for the merchandise. Okay, that's added to the block. Oh, and the bank sees that and knows, good, I'm going to get repaid. So if you go to the next slide, now the supplier has the cash, pays the loan, the bank cancels the loan, it's fully done. The retailer sees that's done. We've got a good solid transaction going in there. And then this is that rebate. Before, some stuff didn't quite sell. So the retailer says, hey, supplier, I don't want to pay you for this, or I already did. I need a refund for that. Here's the stuff I don't need. And here's, record of what I'm sending you. So the information in the unsold goods go. Supplier refunds the difference. All of that is one block. Everybody has access to that information. If I'm an auditor, I just draw little analyzers through there. I've instantly audited the entire transaction. Next. The example of the internet. I couldn't agree more. And this is an article for Harvard Business Review. Basically says, look, if you go back to the early 90s, people were playing around with email with each other, but nobody really got it much, right? Kind of like a Bitcoin payment today. Then when I was working in the early 90s, my company, LexisNexis, we had a little internal, we could send messages back and forth between us. So we thought that was really cool. That's like an internal use of a blockchain. And so the example there is maybe we got some ledgers for financial transactions in our company, but it's pretty much self-contained. As we get to a little more complexity and innovation, now let's work with outsiders. And Amazon comes online and says, we're an online bookstore. Use the internet for your books. Game changer. And then we started e-commerce, right? Well, now that same retailer says, why don't we just buy and sell using Bitcoin? And you can already buy in some DoorDash, I think, is accepting Bitcoin, or is about to, I just read. And then the big ticket item upper right, that's when your lives changed. So now we're on Zoom right now, right? We don't even think about it. That was unimaginable 1990, as Kyle said. And that's kind of what these self-executing smart contracts are going to do. And eventually computers are going to be able to talk to each other with Internet of Things. And that's just going to scale this whole thing up and really automate stuff. So just about done. I'm about to turn it over. Go next. These are the skills you should be thinking about, right? And it's not that overwhelming. You don't have to be an ISA major to be literate, but you do have to understand context. I need to know my industry. I need to know my company. I need to know how business works. Pay attention in your courses. That's the irony in technology. The more technology takes over, the more the human part is understanding people and the way things work broadly. So you should know business. You should have literacy on the blockchain, how it works. You don't have to build the car, but you have to drive it and know when it's not working. You have to understand how to analyze data, right? You're going to be looking at outcomes of this, and what are the humans doing that have automated? They're doing the data analysis, and you've got to solve problems. And if you're going to solve problems, you solve it by thinking those 5 questions Kyle said. Maybe I can use blockchain. Last thing, next slide here. I think this last. The new risks created by blockchain say that your skill set in finance and all the accounting jobs are going to be tweaked. COSO, it may be early enough in your career, but COSO is all the controls you need to put into your transaction. They're pretty good. They're all the accounting groups together. They just put this out last year. Blockchain is legitimate. They now understand there are controls. That's a signal that that's going to transform accounting going forward. Next. And last, this is a great article from last September that basically said, Big Four is on this. The Big Four public accounting firms, here's what they're doing. They actually reference some of the things Kyle's talking about and about to talk about. The cases I've used as part of this module from KPMG. They partnered with Merck, IBM, and Walmart to create a pharmacy private blockchain that's in response to an FDA requirement to make sure there are no forgeries in prescription drugs, and everybody can instantly see and stop selling any drug that needs to be recalled or if temperatures change. Think vaccines, right? All those ones have to be super cold. If one of them gets too warm, blockchain says can't sell it. That's the idea that they're doing. And then also on this idea of custodianship of Bitcoin and other crypto assets. And Deloitte actually co-wrote the COSO white paper. They're doing a lot of stuff. PwC not quite as transparent in that particular article, but they're doing a lot as well. As we had a leader from the firm on the fall summit, if you guys happen to see any of that. So that's just a quick update. I just wanted to get you excited about it. But I'm going to turn this over the what's remainder and let Kyle talk a little bit more specifically about how these the blockchain could really be useful.
Great stuff. I will flip back decks. I see some questions popping up, which we will circle back on towards the end. So I would encourage everyone after we finish up today, again, we said, let's grasp what blockchain is and what it can do and how it can be applied. Get creative, think through things. If you're a tax person, even think about transfer pricing. I don't know if anybody's taken tax classes yet, but there's so many things when you put your mind to it that blockchains can do a really good job of. That if you become passionate in it and you want to learn more, I think your mind starts to run and you just think through things. So in saying all that, what this slide does here is lay out a decent number of the projects EY has currently ongoing. You can see we have blockchain projects through 5 different pillars, whether it's food and beverage traceability, supply chain and drug and medical realms, shipping and logistics, funds management, and labor management. It really just kind of proliferates the point that blockchain will transcend across a lot of industries, not just one niche spot. And the 5 questions we asked earlier, you went back and analyzed each of these situations here, there's a very good chance that you're going to have check marks next to a lot of them. So first things first, why don't we talk about traceability solutions? We have a great example here. Professor, it's Franny Hillier, and tell me if I have it wrong, he's a Miami Mac student. She stumbled across a wine bottle from Lamura Vineyards that had a QR code on it that allowed her to scan the QR code with her phone and check the origin of the bottle. And you say, why is this important? Well, let's go back a few slides. When you do a deep dive into the wine industry, just like luxury goods, call it a Louis Vuitton or Gucci purse or Oakley sunglasses, Ray-Bans, you name it, there's a counterfeit market out there. Same thing in the wine industry. There are plenty of little risk points in supply chain. Someone's getting hold of bottles or creating fake bottles that say it's a really expensive wine, think about printing a label. Printing a label is easy. You can probably really easily mimic a nice bottle of wine with some fancy printing capabilities. So the number that's out there is that about $2 billion in the Italian wine industry were lost due to counterfeited wine. Pretty amazing stuff. So obviously in comes blockchain, in comes a traceability aspect that literally says, when we go back to that one example slide earlier, we can trace this bottle all the way back to the vineyard the wines were grown on. And you effectively certify that the wine is what we hope it to. Same concept with luxury goods. Like I think about sunglasses or expensive purses, wallets, you name it, watches. most of those things today come with a certificate of authenticity, but even that can be faked. Guess what can't be faked? Doing this all on a blockchain. I think we see a lot of this in the future. I don't think it just has legs in the wine industry. I think luxury goods, you see probably hot on the heels. But it's pretty fascinating, and it's really cool to go out there today and scan a QR code and see this. So kudos to Franny. EY, I guess kind of staying on the alcohol line. We're doing the same thing with the Japanese sake manufacturer. Same concept applies. So back to the point I made right when we went into the section, let your minds run. Think about all these things where it would behoove us as consumers and as leadership of a company to have traceability features on it. So great stuff going on there. One other thing I will highlight quickly is one of EY's really big projects with Microsoft right now for any gamers out there with Microsoft Xbox. What we've done is effectively you have Microsoft and video game manufacturers. Similar to the shoe rebate example we did earlier, Microsoft, as part of its contractual obligations with manufacturers, says, hey, every time we sell X amount of product on Xbox Live, we owe you a royalty fee, and it's contractually stipulated. In today's world, again, relating it back to what we did earlier, way too much data, way too many reports, running reports for all the video game manufacturers, checking the royalty fee amount, bring that back to an agreement, running a computation, ensuring the data is run the right way. It was a long, tiresome process that created friction between Microsoft and the video game. Something like it took 45 days just for the parties to agree, sometimes even longer. In comes blockchain. We're programming the smart contracts with the terms of the royalty fees. And as consumables are purchased by users on Xbox Live, the blockchain is calculating what Microsoft owes back to the video game. So the data that's out there is that it has reduced processing time by 99% and has almost 100% near real-time calculation of royalties across various partners. So where this is going, and I think the next kind of giant leap for blockchain in an example like this is to see it become the actual source of truth for both Microsoft and the video game manufacturers, to the point where the parties trust it as a financial record. That's the next step that blockchains need to be. I think right now, early days right now, we're still in inning number 2. It's an alternative source. It might be a subledger that we reconcile against loosely. The next step is for these things to become the ledger, where all the parties privy to the transaction trust. And I think, hey, we're heading into the 3rd inning. That's where we're going. So one other key concept, and I saw Mr. Jack Gilchrist asking some good questions here that I don't even know I can answer, but we'll hypothesize later. You might hear in the news the term decentralized finance. It's been very hot for the last, I'd say, 12 to 18 months. A ton of the excitement in the decentralized world is finance realm right now. So DeFi is the buzzword. Currently, over $40 billion are locked in DeFi, meaning a user has taken its fiat currency, converted it to some sort of digital asset, a crypto asset, and deposit it into a DeFi protocol. So let's define DeFi. Let's define what a protocol is. Effectively, what these things are doing are creating an ecosystem of financial services facilitated through the use of smart contracts. The majority of it is occurring on Ethereum, but there are certainly Ethereum competitors that are developing their own excellent protocols that will compete with the current ecosystem that Ethereum has, no doubt about it. So what DeFi in theory does is extracts value from the traditional financial sector, where there are central authorities and intermediaries that charge fees to do a lot of this. You say, okay, so like, what are these services? And you say financial sector, what does that mean? I mean banks. What do banks do? They give savings accounts. They enable borrowing and lending. They create marketplaces, exchanges, insurance and investment funds. How does this all work? In theory, we have code, right? We have code through a DeFi protocol that is effectively doing a lot of the work that banks do, which we all know, hey, banks are buildings. Banks have humans employed. Banks have to pay for systems. They have a lot of built-in costs. Where the disruption is that this is all code. There's not all this kind of extra cost that we see in a lot of the traditional businesses. It's a bunch of code. So one kind of mind-boggling project for me that I think will help everyone to understand are these three that I've listed up here. Compound, its abbreviation is Comp, Aave, and Yearn.finance. Yearn's acronym is Wi-Fi, YFI. Compound and Aave are both lending borrowing protocols. So a user can deposit their crypto assets in Comp and Aave and earn interest for providing liquidity. In turn, other users can go in and effectively create an instant loan, again, on Comp and Aave, which is just Ethereum smart contract code, and get a loan without going through a week of paperwork and going through a bank and all these steps. The other beauty of it is the users who are providing the liquidity, they can go earn an awesome interest rate that when we look at banks today, hey, we're getting like 1% at best. Some of these, you'll be stunned to see some of the interest rates that they offer. Now there are, of course, there are risks. Early days, there have been hacks on a lot of these protocols, but I like to say hacks are good. Hacks are us working out the kinks, and projects that go on to do great things are the ones that overcome them and survive. Survival of the fittest, we know that. I got to weave in Wi-Fi before we go to questions. I know we're at time. What Wi-Fi does, if we take today's world, if you're someone who likes to move your cash around to get the best interest rate at a Chase or any bank, PNC, any bank that's out there, you have to do it all manually. What Wi-Fi does, again, using crypto assets, is look at the different protocols like a Compound and an Aave and check to see which is offering the best rate. And what the Wi-Fi protocol will do is move the funds you've deposited around automatically. It's a yield optimizer to earn you the best rate. That takes a lot of time and effort in today's world using cash. It takes time for the cash to clear. But again, just thinking through that we're so early on and that these are just some of the kind of preliminary things that these protocols are doing. Pretty amazing stuff. I guess in kind of my parting words before we do questions about the accounting practice and finance, they're both phenomenal majors. I know for me, accounting is a specialized skill set that you truly can carry throughout your life and differentiate yourself from others, because hey, there are a lot of business people out there who weren't accounting majors. Some of the concepts are tough to understand. So aside from all the things that we do, I will promote in some of the technology concepts. I applaud everyone, all the accounting majors on here. It's great stuff. Thank everybody for being here today. Before we do questions, Professor and Alex, any final thoughts?
No, I think you summed that up very well. And I would just encourage those of you on here to reach out to people like Kyle whenever you can, just to learn more about it, because this isn't going the horse out of the barn. So it's not going to like go a different direction. I think governments are going to get in the way a little bit, slow things down because they're nervous about it, but it'll get figured out. And I think this is a fundamentally different way to do accounting, and that's what makes it different.
Yeah. Well said. I think we should move on to questions now. We have quite a few in the chat, so um, we could start from the top and go to the last one. I think that's probably the best way to do it. Um, can you guys see the questions in the chat? Kyle and Professor
I
Ballou?
can see them. I can see them to everyone. Do automated market makers, aka Uniswap, or programmable liquidity vehicles, balance or ask, present any novel use cases in the context of ERPs? Phenomenal question. I'm going to give a Kyle opinion. I might change the word ERPs and put company. I believe that hey, like I said, there are a lot of risks with these protocols right now. There are bugs in the smart contracts that are, you go on and type Wi-Fi hack, or there are a lot of hacks that have happened and people have lost money, but in most times they've been made whole. There are risks out there. But as they continue to grow and mature, I envision a world, imagine you're a low margin company that is high volume. You earn a ton of cash, but you don't make a bunch of margin. I envision a world where you say, hey, I'm a company I'm cash rich. What am I going to do with it? I can't put it I put it in a savings account. Oh, great, I get 0.8%. Why not put your cash into one of these protocols and earn a yield that is multiples of your margins if you're a low margin, high volume company? I truly see a world where that starts to happen. I also think there might be a world, another Kyle opinion, this is not an EY thought. I think there might be a world where we see historically non-interest bearing assets, let's call it everything not cash. We might see tokenized non-cash assets that are able to earn interest. Go back to shoes. What if a service provider was able to say, hey, I know you have $5 billion in shoes in your warehouse. I'm going to allow you to tokenize it, likely put some collateral into my protocol. And because some big four auditor said, yes, that 5 billion of shoes is accurate because it's on the blockchain, I'm going to give you some sort of yield on your shoes because I know your shoes are valuable. It's kind of a crazy concept, but I can see a world where we go to. And it'd all be about, hey, does that provider want to take on that risk? Maybe, maybe not, but tokenizing things changes. So food for thought. Jack, I know I didn't quite answer your question to the T, but maybe a couple things that are relevant. All right, Mike, what kinds of impacts might blockchain have on law enforcement in regard to sharing information among departments? I'll say this, I don't know enough about the behind the scenes in law enforcement, but assuming like any government or any company, you have siloed systems or siloed data that some user, like, hey, let's say you're trying to track humans' payment of fines or parking tickets. And you have one city that's on X system and another city on Y, and you're trying to make sure everyone's paid. I think blockchain may play a great role there, and sounds awful, not only helping governments track it, but it might ultimately help them like automatically bill you. So that's a little bit of the scary concept that is probably for another time, but there are some things about blockchain that, maybe give a little bit too much visibility or too much automation. But yes, I think the short answer to the question is blockchain will help law enforcement.
I'd add real quickly. I'd add real quickly, that's the time. Like if you're worried about somebody on the loose or you're trying to track somebody, some information that might have taken 1 or 2 days before might be 10 seconds. They're seeing it in the pharmacy recall thing. They thought it might take up to 3 days for a recall to get all the way through the system. 10 seconds. So it clearly can save lives in some context in law enforcement without question.
Jack, he's challenging the authenticity of the QR code on the wine bottle.
You could add to what I wrote. I answered part of that. It's
in the blockchain, man. We can deal with that offline. Oh, okay, you got it. Cool. All right, Miles. I've used a couple different wallets for Bitcoin. Sometimes when I try to send it between one wallet to another, it tells me the blockchain is busy. I can't send it at that time. Is this something that is only specific with the wallet I use? If so, will this go away as blockchain is improved? Or is it always a possibility that there will be times where the blockchain is too busy to process transactions? I'd love to know a little bit more specifically where that happened, but it gets into a really good thing going on with Ethereum right now. And I know we're out of time, so obviously feel free to leave. One of Ethereum's challenges right now as a proof of work blockchain, and we didn't even go into this concept, the transaction fees are extremely high. So if you go do some reading, Ethereum is doing a lot to transition the blockchain from proof of work to proof of stake, and B, even a couple of things from a supply burning standpoint that they believe will help to alleviate some of the congestion on Ethereum's blockchain. But in theory, hey, when you're a miner and there are all these transactions and there's a specific amount of data that can effectively go in one block, and there's all this congestion, mostly as a result of $43 billion being locked in DeFi, it has caused Ethereum's transaction fees. Miles, I'm assuming that's what's going on, and that ultimately, like, the fee that needs to be paid is so high, you know, maybe it's saying, like, we're not even going to let you do a $20 transaction because the fee is higher than the actual amount you're trying to send. But hey, for miners right now, it has been extremely profitable for Ethereum miners in the last 12 months because of the DeFi boom and just how much of this volume is moving on Ethereum's blockchain. So it's all good. I mean, it needs to get fixed, and it's giving a lot of room for the competition to battle Ethereum very hard right now because they'll say, we have a more scalable solution that's cost efficient. Ethereum's got to respond to it. Fascinating stuff.
Okay, looks like there's no more questions in the chat. And we're out of time anyways. So I want to thank again Kyle and Professor Ballou for being here. It was a great talk. I did record this and it'll be posted on YouTube sometime later this week if you want to rewatch it in case you missed anything, or if you want to share it with a friend or something like that. But yeah, again, thank you everyone for being here. Big thanks to Kyle and Professor Ballou, and yeah, that's it for the meeting. Everyone's good to go.
Thanks, guys. Appreciate it.
Thank you.